Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Intrinsic value number one is the current earnings per share for the company over a high hurdle rate, which is currently 19.5%. So I'm looking for stocks that are deeply discounted based on their current earnings. And that's one element of the heat map. And an IV number two is more like how a traditional stock market analyst would look at it. It's the forecast earnings per share. So what's this company going to do next year? And I put it over a lower hurdle rate, which is the risk-free cash rate plus 6%, which is called the risk premium.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How much is a company really worth? And how can you measure its value? What's the difference between market value and intrinsic value? Today I'm welcoming back to the podcast old friend of the podcast, Tony Kynaston. Hello, Tony.
Hi, Phil. How are you doing?
Good, thank you. Great to have you back on.
Thank you.
Tony is the mind behind the Quality at Value system, or QAV. Tony's disciplined, checklist-driven approach to value investing has delivered an impressive average annual return over double the Australian market index. So intrinsic value is only one measure of value. Overall, there's a whole concept of valuing companies. Give us an overview of value, Tony.
Yeah, thanks, Phil. It's a really interesting topic. And in my experience, no one can nail a value down to the exact dollar or the exact cent for a company. And so in my mind, I see valuation as almost like a heat map. So here are all the ways I can value something, and I put them all together, and I can get a green reading to say it looks like it's a good value investment, or I can get a red reading saying it's a bit expensive. So that's, I think, the first thing to note. And if I break it down, there are two broad ways of valuing a company, either by its assets or by its earnings. And people will be familiar with that if they haven't had any sort of experience in valuing companies at all, just from, for example, valuing their house, which tends to be an asset valuation metric. And all valuations also tend to be based on relative comparisons. So for a house, if you're thinking of buying a house or if you're thinking of selling a house, you'll be trying to work out what the right price is for that house. And the only way you can really do that is to look at comparable house sales in the area in recent times and then say, well, I'm selling a 2-bedroom apartment or I'm selling a 4-bedroom house, and here are 3 or 4 other ones that have sold that are like it in a like suburb, and they've gone for a per square metre valuation of X. And therefore, if I work out my per square metres, I can think my property is worth about X times the square meterage. That's a good example of how to value something. If I apply that to a company, the company's going to have assets as well, and they're going to have relative values. So we talk about the coffee shop analogy in QAV, and if people can think about their local coffee shop, it's made up of the assets and it's made up of the earnings when they come to think about what it's worth. And, you know, the saying in the stock market is price is what you pay and value is what you get. So if your local coffee shop puts a for sale sign up and you think you might want to be a barista and get into the coffee shop business, you've got to work out whether the asking price for that coffee shop is overvalued or undervalued. And so you've got to have a good idea of what the value of that coffee shop is to you. So the first thing to note is, does the coffee shop actually own the premises? And if it does, that's an asset. And then what's that worth? And so you can say, well, it's a retail shop in this particular area with this per square meterage. Here are 3 or 4 other ones which have sold recently, and therefore I can work out what the assets are of the coffee shop. You also have other assets like the coffee machine, the tables and chairs, the stock that's on hand, that kind of thing. And again, you can assign values to each of those things based on perhaps what they were purchased for, less the wear and tear on that. You can, again, look at comparable sales. You can go onto Marketplace and have a look at what coffee machines are selling for and assign a value to it. Add up all those things, and then you can say, okay, that's one valuation for what I'm buying. But then there's also the business side of what you're buying. And a traditional way of looking at the valuation of the business side, not including the assets, is to look at what it's earning and how long you think you might get those earnings for. And that kind of valuation is traditionally called a discounted cash flow, which is a kind of technical way of saying that the coffee shop's making X number of dollars now, and if I extrapolate that out into the future, how long will it take me to get back the asking price on the coffee shop? So obviously we want that multiple to be as low as possible. So I would like to give you, say, 1 year or 2 years income as my bid to buy your business, but you might be asking 5 or 6 times. And so again, you've got a number of ways of looking at that valuation, and it's all comparable. So my offering 1 or 2 might be based on the fact that I know from a bit of research that there's been 2 or 3 coffee shops in the area which have sold recently at that kind of 2 or 3 times earnings. You might have been working in the coffee shop business for a long time and think your business is worth more than that because you have loyal customers, you have good supply contracts, et cetera, et cetera. And so in a one-on-one transaction, we're going to negotiate. That doesn't happen in the stock market when you're talking about a coffee shop business that's listed, unless you look at it over time and think that the current multiple of earnings for that coffee shop business that's listed is currently more than what you want to pay for it at 6 times earnings. But at some stage, coffee beans will rise in price, retail will go into a bit of a recession or whatever. It may come down to be 2 times earnings, and that's when you might want to buy a coffee shop business based on your experience of what the value is for that business. But in all those things, there's a couple of concepts. One is the relatables. So that's often called the hurdle rate if you're reading about valuations or you're listening to people talk about valuations. In a stock market sense, the hurdle rate is often compared back to the risk, what's called the risk-free hurdle rate, and that's the yield on government bonds. Oftentimes 10-year, sometimes 5-year bonds, depending on where they sit in their cycles as well. So it's called risk-free because you've got to park your money somewhere if you're an investor. Putting it in the bank and receiving an interest payment is probably the least risky way of doing it. If you have enough money to go and buy a government bond, that's kind of equivalent risk. And you usually get a little bit more out of a government bond than the bank's prepared to pay you because they've got to make a margin. So the government bond yield, if you invert it, say, for example, the government bond yield is currently 5%. So if you buy a US government bond or an Australian government bond and you get 5%, then you're paying 20 times that as the price of the bond, because you're getting a 5% coupon. So that's the valuation metric for the risk-free investment. And so the PE is 20. So then in the market, the stock market, we say, well, is the company I'm buying riskier than the government bond? Well, yes, it's not, the government isn't listed and companies can go broke or they can have downturns or whatever. So you want something better than that price to invest in that company. And so you're always
you're moving up the risk curve, aren't you, here? Correct. At this point?
Yes. And so in that particular case, I would be looking for something on a lower multiple than 20 times to try and take that risk into account. And so you're looking for something cheaper than 20 times earnings, depending on how risky the company is. Now, if it's a small coffee shop, it's probably a lot more risky than the Australian government or the US government. So you're looking for a much lower PE than 20 times. So that's kind of, I guess, an overview of how you value things. You're always relating it back to how much risk you're taking on or how much the assets are worth.
Okay, so just to clarify, there's 3 concepts that you spoke about in that answer. The first one is the value of an asset, which is like your house. Then the value of a business, which is to do with its cash flow. And then how much risk you would be taking on, which means that you want to pay a lower valuation for a company that's got more risk. Is that a fair assessment of those 3 concepts?
It's a very good assessment, yeah. And that's why I say valuation is always kind of a heat map because there are a number of moving parts there. And I think the other thing to touch on as well is what I'll call prediction, which is always the hardest part of valuation. And so if you think about the risk of buying something like a coffee shop business, I want to get my money back as quickly as possible as a way of lowering my risk of having my money invested. And in the stock market world, that relates to having a low price to earnings ratio, if you think of it that way. So I want to be repaid by the business quickly. That lowers my risk for having the money invested. And then after that, if the business breaks even for a while, okay, I've got my money back. If it makes money, great, I'm getting a good return. If it loses money for a little bit, I can write it out because I've got my money back. So that's the risk side of things. If you're using, I guess, a spreadsheet or a valuation metric called a discounted cash flow, what you're trying to do is to say, again, if I hold a government bond for 10 years until it matures and I get my money back, I will have made 10 times the premium the government's paying me for loaning them money, plus my money back. So that equals this over 10 years. And then I compare that to the coffee shop, and I suddenly start to think, well, in 10 years' time, I don't know how much this coffee shop's going to earn. The owner's telling me for the last 10 years it's gone great, but I've got to start making assessments about, is there going to be a McDonald's moving into the area soon and they're going to have a McCafe, which might interfere with my market share? Is Starbucks coming into the area? Is Starbucks closing and I'll do better? So you're starting to have to try and understand a lot of what's going on in the industry and the market and with competitors and with things like, what's the coffee bean price going to be in 10 years' time? And so it becomes a very difficult thing to do the longer you have to extrapolate out into the future for a discounted cash flow. Much harder than looking at a government bond and saying, I get 10 years worth of a 5% coupon or dividend for lending the government my money for 10 years and then I get it back at the end. So in your discounted cash flow, you've got to put what's called a higher hurdle rate for the unknown in there to take into account not just the risk of the business, but also the risk of you not knowing what's going to happen to the business in the future. And so you'll hear the concept of a hurdle rate when you're talking about discounted cash flows. And that's oftentimes where valuations come a cropper, because if you think back to my experience with the dot-com boom, people would say that this company is going to go to the moon. It's going to, the number of eyeballs looking at this website is in the billions, and they just have to monetize that. Well, again, that's a lot of predictions in there. And as it turned out, the predictions were wrong, and a lot of companies went broke when the dot-com bubble burst because they had these cash flows which said, we've got so many people looking at the website now, if we can just get $1 from them in earnings going forward, we'll be rich. But they couldn't do that. So again, you've got to be very careful of what the predictions are being based on when you're buying something in the stock market, and do your own sort of assessment on risk and on what you know about the industry or what you think might happen in the industry. From a QAV point of view, I try and bring all that back to the foreseeable future. So I'm looking at the current earnings of the business, and if there is a forecast 1 year earnings, I'm looking at that and not trying to go out any further into the future than that in forecasting, and just come up with a multiple based on a hurdle rate to get a value for the company based on the sort of things I can know about and the sort of things which have a short-term play out, rather than trying to stick my wet finger in the air and work out what's going to happen in 10 years to this business.
Is there a difference in the risk-free rate or the hurdle rate for a company, say, like Procter & Gamble, who've got a long history, strong brands, as opposed to, say, a tech startup company? I mean, what's the variance there?
Well, it's huge. I mean, one of the other things which QAV helps with is we're looking at the past performance of the business. So a Procter & Gamble has been around for a long time. It's been throwing off a lot of cash. We have a higher degree of confidence it's going to be there into the future. I still can't predict what Procter & Gamble earnings will be into the future, but we know it's a cash-producing business that's been around for a long time. They're often called a blue chip company. And so the market generally ascribes it a higher price earnings multiple because of that. So if the risk-free bond is 20 times PE, Procter & Gamble is going to possibly trade around that. I don't know what the PE is for Procter & Gamble, but it's going to be seen as closer to the risk-free rate than a startup, because a startup is, even though it might be exciting and have great prospects and a good story, it's still got to actually do something and produce cash and go through all the kinds of headaches that a startup can do. And so if I was valuing a startup, first of all, I'd find it very hard because I look at the cash flow of a business and it's probably not producing any cash. So I tend not to invest in startups. I'll wait for it to prove itself. But if someone wanted to look at it, you'd want to have some kind of discount to other uses of your money to compensate you for the risk, which is oftentimes the reverse. Generally, you'll have to pay a lot for a startup based on its story, which is kind of counterintuitive in my opinion.
And then sometimes you've got to pay a lot for quality. Well, hopefully not if
Well, you
you're
do.
doing a quality of value. Yeah, but there are so many great companies that spit out cash year after year, but getting it at the right time, that's the trick, isn't it?
Well, that's why you've got to have it in your own mind what you're prepared to pay for it. You know, the market's always going to offer you a price, but you don't have to accept it. And then one day you will. And that might be in a recession or in a GFC or, you know, just on a down day in the market or after a quarterly earnings update, which wasn't good or whatever. And you've got to decide, yep, that's a good price for Procter & Gamble or that's a good price for this startup. And I'm going to pay that because it's closer to my value than what it was trading for last week or last month or last year.
Okay, so let's focus on intrinsic value, which of course is only one measure amongst many. But how do you define intrinsic value and where does it sit in your valuation heat map?
Yeah, so it's one part of the heat map, and I call it a shorthand calculation in QAV to come up with intrinsic value, and I use two metrics. I call one intrinsic value number one, and the second one intrinsic value number two. Nothing groundbreaking there. Intrinsic value number one is the current earnings per share for the company over a high hurdle rate, which is currently 19.5%. So I'm looking for stocks that are deeply discounted based on their current earnings. And that's one element of the heat map. And then IV number two is more like how a traditional stock market analyst would look at it. It's the forecast earnings per share. So what's this company going to do next year? And I put it over a lower hurdle rate, which is the risk-free cash rate plus 6%, which is called the risk premium. So at the moment, you're probably looking at that hurdle rate being about 11%. And it's based on the forecast earnings per share, because one of the issues with valuation is if whatever number we use is probably going to be wrong, whether it's current or forecast. So it's better off to use two and then compare and contrast them. There's been plenty of companies which look good to buy based on their current earnings, but their forecast earnings are going backwards. So you need to take both into account when calculating your IV. And my simple calculation, which I got from a book called the Warren Buffett Workbook, which is worth reading out there if people are interested in the detail behind all this. But it's a quick and dirty calculation that summarizes a discounted cash flow. So rather than saying, here's my 10-year forecast or 5-year forecast for earnings, and then I've got to discount it. So I've got to say that in terms of what a dollar is worth today, in 10 years' time, I've got to discount for inflation or risk or whatever else. So a dollar earned today, to me, right now, might be worth 50 cents in 10 years' time because of inflation or because of all the things that could happen to that dollar along the way. And then if I discount what I think the earnings will be in 10 years' time, 9 years' time, 8 years' time, add them all up and then divide by 10, in rough terms, it's like putting the current or the forecast earnings per share over a hurdle rate. And that hurdle rate, if it's close to the discount rate you're using in your DCF, you're getting a very similar sort of valuation for the company. So I'd prefer to do a quick and dirty calculation like that based on the two metrics we know and hurdle rates, which are number one, commonly used, and number two, a higher benchmark because I'm looking to put deeper value into the portfolio, and then use both of those as part of a checklist on valuation. Then I can arrive at a sort of overall calculation for whether it's red or green on the heat map for buy or not.
Okay, so just to clarify on IV2, the second IV calculation, this means that you're looking at just the forecast that's provided in the company numbers 1 year out. Is that the first part of it?
Correct. Yep. And it's normally, a lot of companies will do that. Some companies won't give an earnings per share forecast, but you can generally go online and look at what the analysts think the forecast earnings per share will be as a market consensus.
Okay, so then you take that number and then you discount it based on the risk-free rate and then with a 6% buffer. Is that how it works? I mean, just give us a practical example. Yeah.
Yeah, sure. So if the forecast earnings per share for the coffee shop is 10 cents and then the risk-free rate is 6%, that's a sort of standard in the accounting world. And then I add the cash rate, which is currently 4.35 or 4.15, I think, in Australia. I could have that wrong, but anyway, I'm just making numbers up here anyway. But it gets to about, let's just say to make the numbers easy, it gets to 10%. So I put 10 cents over 10%, and I'm getting $1 as the price I want to pay for that coffee shop I'm getting 1.
So that has to be deeply discounted. The market value of a company has to be deeply discounted as opposed to the intrinsic value, doesn't it, then, for it to actually even show up on your radar?
Well, it is a valuation screen for sure, but the IV2 calculation generally gives you about the market sort of forecast for the price of that company or the valuation for that company. Doesn't mean the company's trading at that, but that's kind of what the market thinks it should trade at. Whereas the IV1 calculation, say it earned 5 cents this year, and we're putting that over 19.5%, then you want to pay 50 cents for the company rather than $1. I hope I got the math right. I'm just doing it on the fly. But the one with the higher hurdle rate discounts what you pay for the company more than the one with the lower hurdle rate. The lower hurdle rate is what most analysts will use. And so that gives me what I think the market consensus is for valuation. And then I also use a deeply discounted one by having an increased hurdle rate. And then I put them both into as part of the checklist on valuation.
So many analysts who work in this, the high-powered, high-paid analysts, they will spend a lot more time and they'll put together an intrinsic value based on discounted cash flow. And as you were referring to, looking out 10 years into the future. This doesn't sound like a particularly accurate way of looking at things, because no one's going to be able to look at the price of a company in 10 years' time or how much it's going to be earning, can they?
Yeah, correct. I will sort of put one caveat on that. If you have a good stock analyst who knows a company well or who knows an industry well, and there are stock analysts out there who just work on banks or who just work on retail, who just work on mining, then they'll know, pick the mining analyst, they'll know the cycles in the mining industry, in the commodity they're looking at. They'll know the players in the market. They'll know what M&A deals are coming along, et cetera, et cetera. And so they'll have a much better feel for a 10-year discounted cash flow than a general analyst looking at it. So, yeah, so there are analysts out there who are pretty good at doing discounted cash flows, but even then, they'll be the first people to admit that it's a forecast on the spreadsheet and things can go wrong next year. So they, like me, will want to buy things when the price is discounted to even what they think the price is worth, because they understand the risk of the industry they're working in.
It's interesting. Before I started this interview today, I was just having a quick browse of Investopedia and about intrinsic value. And they said one of the measures that some people use is governance as well, which I wasn't aware of. And they showed the example of a company where the CEO ended up in jail. And that's when the share price went down, 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 down. And then another analyst comes along and has a look at the intrinsic value and goes, oh, okay, despite the CEO being in jail, it's actually worth this original amount of money before it went down. So I know there's qualitative parts of it as well, but you wouldn't say qualitative or how much you perceive a company to be worth as having any relevance here at all, would you?
Well, if you're talking about what's called the governance discount, I don't use that in my valuation. So
I've never heard about this. There is a governance discount, is there?
Yeah, stock analysts will talk about it. So we tend to use the term red flag. So there are certain companies that we won't buy because we think their governance has been poor. And a good example of that is that they've surprised when they've released their results. It's been worse than they've been flagging to the market or the market has thought, or much worse than their past results have been. So something's out of sync there, but they haven't told us until they are forced to drop their numbers. So that's a red flag governance for us, and we'll put a red flag and park them until we see an improvement in that dimension. But some analysts will actually, put a value on what the governance discount is. Other ones that are similar to that is they'll talk about sovereign risk. So what you see in the Australian market is that, say, a mining company that has a mine in Kalgoorlie in Western Australia will trade on a higher price earnings multiple than a mining company that has a similar gold mine, but it's in West Africa. And they'll call that the governance discount because, whether it's right or wrong, they'll say West Africa is more risky from a government point of view than Western Australia. Now, how much is that discount worth and what's the correct valuation for that discount is worth comes down to opinion, really, but it is worth something. So
it is worth something, and it's a way of building in a margin of safety, I would assume.
Correct.
Into your intrinsic value calculation. Yes.
But it's also what I've tended to find in my experience as an investor is if you can buy the West African gold miner at a discounted valuation and then there's no sovereign risk event, much better than buying the Australian gold miner at a higher price. So sometimes the valuation is actually overdone as well, or the valuation discount is overdone. And if you can, again, it might be correct, but if I probably take this to the extremes, if you look at the company working in West Africa and you look at what they're doing and how they're embedded they are in the community, et cetera, to me, it looks pretty safe. Yes, it can change, but so can Australia change. I mean, we're going through an election now and there's no policy to change the mining sector, but we could wake up tomorrow in Australia and find out there's a royalty on gold mines that wasn't there yesterday. So there's sovereign risk everywhere as well.
And of course, by the time this goes out, we'll know the result of the elections.
Hopefully,
who knows anything about the future? Yeah. Yes, that's right.
I think that's a really important point too when you're talking about valuation. Who knows anything about the future? The last sort of little while has taught us a lot about our inability to predict. We've had worldwide epidemics. We've had regime change in stable countries. We've had all sorts of turmoil in trade agreements, etc. So it's very hard to predict the future. That's why I like to let's just look at the current numbers and maybe sneak in the forecast earnings per share for a short period of time into our valuation and just try and work on that. And my rationale for that is, as you said before, Procter & Gamble has been, producing earnings for a long time. And it's likely that their management knows how to deal with all these curveballs that get thrown to them, and they'll continue to produce earnings in the future. So that's kind of our test on management. It's part of the quality of the company, the fact that it's been able to have cash flow for a reasonable period of time. That's positive compared to a company which is starting up or going up and down in terms of its profit. It has to be a discount on the valuation for that company compared to Procter & Gamble.
Mm. And I also recall the time we were chatting around the time of the COVID crisis and stocks were plummeting, and your response to me was 2 words: situation normal.
That's right, situation normal. You can't forget that what we're talking about here is a market where it's you and me deciding on what to pay and buy and sell a company for. And we're both humans, and even though there might be more tech involved these days and high frequency trading, et cetera, it was all set up by humans. It's a human market. And it's not dissimilar to going down to Vic markets, or if you're in the US, going to the Pike Street market in Seattle and watching the traders shout the price of fish or whatever else, and you can decide to walk by or you can decide to pay. The markets are going to open every day. They're going to trade every day. You can browse or you can buy or you can sell. So, but there's as much a human element to it as there is a spreadsheet element to it, or a DCF or an IV or a valuation element to it. I think what that means is I've got to keep my emotions in check. And I've been evolved to do that using a framework, which we call QAV. But it's really important in my mind to have your methodology of valuation set in rules before the curveball gets thrown and you have to make a quick decision about whether you're a buyer or a seller, rather than try and sit down and work it all out from first principles when a new situation presents itself.
And we've all heard of the concept of value traps. And this is something we really need to guard against, isn't it? Because too many times it's easy for a novice to go, oh, that company's fallen by, 20%, 30%, 50%. It must be cheap now. You really do have to have a framework, don't you?
We do. And some stocks are cheap for a reason. They've had problems, or the industry's in decline, or whatever. So doing a valuation for a business based on its current earnings and its immediate forecast earnings is one metric as part of a whole checklist to decide whether to buy or not. Sentiment is another one that we use in the QAV process. So what does the market think is going to happen to this stock or this industry? That's important to factor into things. And also, I guess, do a bit of research and a bit of reading on the company. A good example is one that we did a deep analysis on about a month or two ago. A mining company in Australia that is throwing off lots of cash. You can buy it cheaply, it looks great. But they've recently came out and said, we thought we need to spend X millions of dollars on extending the mine life. We're not going to do that now. It's not worth it. And the mine will shut next year. So, looking at the numbers on the current basis, it looks great. You then need to go and look at the sentiment, because the share price dropped dramatically when that announcement was made, to say, okay, something's going on here. I don't want to buy it. It's a falling knife. It's dropping in price.
So what advice would you have for beginners to be able to implement the concept of intrinsic value without getting overwhelmed or too confused? I know you've explained it here before, but is there any way of simplifying it even further?
Oh, gee, I don't know about simplifying it further. If you're a beginner, you can use a system like QAV to give you a number. You can use your real-world experience, like buying and selling houses or apartments or cars or sofas, whatever else, to get a feel for when you think something's worth what the price is on the sticker. You can use, when I first started out, I paid a lot of attention to the price-earnings ratio, and that's where valuation has always started in the stock market. And that's a quick way of comparing the price you're being asked to pay for the company versus the market versus things like the risk-free rate. And so you can look for, below average market PE ratios and do a screen based on that as a starting point. But what I found out was that that's one part of the story. So you've got to look at I guess what you call the secondary effects. Why is it cheap? What I found was that earnings, which is one part of the price earnings ratio, can be manipulated. And so I focus on operating cash flow, which is much higher up the earnings statement than the net profit that goes into calculating earnings per share. And when I say manipulated, it could be for valid reasons, that a company has a very different sort of earnings profile to the cash it's producing. Could be that it's got to put a lot of money into CapEx, could be that it's got to pay a lot of tax, could be that it's heavily geared, et cetera, et cetera. So just looking at the earnings per share is the starting point. But that's certainly a good starting point for a beginner to start to get a feel for companies which are in the value side of the spectrum.
Yeah, it is a starting point, but often beginners don't even understand that the PE ratio means different things in different industries as well, and due to differing accounting standards even between different industries. Yes,
correct. And a good example is the tech industry, where you tend to have high PE ratios, or even the mining industry. Explorers will have astronomical PE ratios because they're probably not selling much. And that may or may not be a good time to buy them. I've met plenty of mining analysts who say the best time to buy a mine is when it's on a high PE ratio, because it's just starting out and the PE ratio will come down as the sales go up. So, but again, at that stage in the cycle of a mine, you're reliant on the fact that they can actually scale up and produce. So I'd rather put that one aside and come back to it when it's producing cash, throwing off lots of cash and the price of the commodities going up, and I can have some confidence that if I buy it for this valuation, I'm going to get my money back from cash flows in the short term going forward, or in the shortest term possible going forward.
That's all you want, the shortest term possible.
Well, that's how you mitigate risk, in my opinion.
Yeah.
Get repaid quickly. Get your money quickly. What's that old saying? It's money not yours till money in pocket. That's what we're trying to do quickly.
How often do you reassess intrinsic valuation? Is it during reporting season when the numbers are actually published from companies?
That's the main one. When we're using forecast earnings per share, that can be updated quite frequently. So we run a buy list once a week, and then the checklist goes through and recalculates. And if there's been an update to earnings per share from analysts and we get the consensus on that, then it will update. But obviously the current earnings per share is only updated once the earnings are released, half yearly in Australia, quarterly in the US. And so that number changes relatively infrequently, but the calculation that uses the forecast one can change in between. I guess that change in the overall checklist doesn't produce a material difference in the valuation. It's one part of the checklist. So, a change in the forecast earnings per share may affect sentiment more than it perhaps affects the checklist score.
So with stocks in the US with a quarterly earnings report cycle, is the frequency updated much more quickly in the QAV process?
Well, yeah. So like I said, we'll download a weekly checklist. So we're checking it weekly anyway, because the stock price will change around, and one of our key metrics is price to operating cash flow, so that changes with the stock price. But yeah, it means 3 monthly we'll get earnings per share numbers to plug in and change. Haven't seen it be too different to the Australian methodology so far. So we get numbers every 6 months that change versus 3 months that change. I guess I'm going to draw a broad brush here and say that in Australia, there's a thing called continuous disclosure. So you can get updates along the way in Australia, which might change the forecast earnings per shares. You tend to get that in the quarterly earnings updates in the States. So yes, the numbers will change 4 times a year for their current, and the numbers will probably change 4 times a year for their forecast. And that's about what it does in Australia as well, if you sort of average it out across all the continuous disclosure that goes on.
So if listeners want to find out more and take advantage of QAV, where can they go and find you?
Yeah, QAVpodcast.com.au. That's for the Australian show anyway, QAVamerica.com for the US version, for US stocks. But yeah, that website will have all the sort of resources that we offer. It'll have lots of videos on what we do and how to understand what we do. And it will have the ability to sign up to be a club member or a light member, or to download the free part of our latest podcast, which we do weekly.
Yeah, so the free part of the podcast actually gives you a good overview of how you're doing it and valuing particular companies and the methodology and insights into it, isn't it?
Correct, yes. Yeah. And that's been going for 6 years now in Australia, so there's a bit of a track record there.
And if listeners are interested, we've got a coupon code, which is for QAV Club. There's a 20% discount if you use the code SFB, or SFB Lite is the code for a free month of QAV Lite. What's the difference between QAV Lite and QAV Club?
So QAV Club is what I'll call the full membership. You get all the bells and whistles. So you get the full podcast where you can ask questions, and I answer questions about stocks or about investing in the second half of our show. And you get access to the Facebook group where there's a community of like-minded investors, and they often help each other, which is great, and help us improve our tools to invest using the QAV process. You get full access to the tools we use, the checklist you can download yourself, and you don't have to wait for us to do it once a week on a Monday. If you want to buy a stock on a Thursday, you can download and run your own numbers yourself and produce a checklist and a buy list. You get access to what we call the 3-point trend line calculator, which is our sentiment checker, which gives us our buy and sell prices on stocks. So you get access to the tools. That's the full membership. And then the light membership is basically we set up portfolios and trade them using that QAV methodology. And then we'll put out an email saying, here are our buys and sells. And it's up to you whether you want to buy and sell to follow us, but at least you know what we're doing. And you can use that to inform your decisions for your own portfolio.
So you're not flying blind.
That's right, yes.
Fantastic.
So, and you can follow along for a while too before you dip your toe in the water.
Yeah, run a dummy portfolio or just see how it's going.
Yeah.
Fantastic. Tony, thank you very much for sharing your wisdom again.
Great. Well, good to come back on the show. Thanks, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.